Imagine a bustling city where every street is lined with thriving businesses. Over time, these businesses grow, their assets multiply, and their profits soar. This isn't just a temporary boom, it's a long-term trend fueled by innovation, expansion, and a touch of inflation. As these companies flourish, so do their stock prices, pulling the entire stock market index upward over the long haul. Now, let's zoom in on who truly benefits from this upward journey. About 93% of the wealth in the US stock market is held by the top 10% of Americans. Who are these people? They are the wealthy elite, the CEOs, and board directors of top companies, the fund managers at major financial institutions, and the influential institutional investors. They have the knowledge, resources, and influence to ride out even the most severe market downturns. Imagine the most catastrophic event, say World War III with nuclear weapons. The stock market would undoubtedly crash, hitting lower circuits day after day until the conflict subsided. But would these wealthy individuals panic and sell their stocks? Unlikely. They would wait out the storm, using their influence to help settle the crisis while keeping their investments intact. Now picture yourself an average retail investor in this scenario. Amidst the chaos, you'd be gripped by fear, struggling to make ends meet, and bombarded by doomsday predictions on TV. Panic would set in, and you'd likely sell your stocks at rock-bottom prices, just to salvage whatever you could. Even if you didn't sell, would you dare to buy more stocks during such a crisis? Probably not. In this panic, retail investors would liquidate their portfolios, driven by the belief that the end is near, just as many did during the pandemic. So who would scoop up these undervalued stocks? The rich, of course, with their reserves of capital and access to credit. They'd seize the opportunity, buying high-quality stocks at dirt-cheap prices. By the time the war ended and normalcy returned, you'd be left with no stocks and depleted savings, while the wealthy would have amassed even more wealth. This isn't just a hypothetical scenario. History has shown us that markets rebound after crises. Whether the crash is 30%, 40%, 50%, or even 70%, the market eventually bounces back to its previous levels. Those who buy during these short-term crises emerge as winners, while others lose out. Over the past 100 years, the S&P 500 has delivered an average annual return of 10% despite numerous downturns. Think of Warren Buffett. He has lived through many such events and made colossal amounts of money by staying invested during each crisis, becoming one of the richest people on Earth. His success isn't just about staying invested. It's about strategically buying during downturns and holding on for the long term. So the moral of the story is clear. No matter how severe the crash, the stock market will recover. Those who have the courage to buy during crises will emerge victorious, while the rest will lose out. This is the essence of Buffett's famous advice: be fearful when others are greedy, and be greedy when others are fearful. Suppose you understand everything and something like this happens tomorrow. You have $20,000 to invest, and you're ready to be greedy when everyone around you is fearful. But what will you buy? All your life you've bought index funds and mutual funds. Your $50,000 worth of mutual fund or index fund investment is already 50–60% down, with a current value of $25,000 or $20,000. How will you differentiate which stocks to buy? In the midst of such turmoil, will you have the clarity to identify the right opportunities? What will you need in that scenario to find opportunities that may multiply your money by 10, 20, or even 30 times? Will an index fund do that? No way. Then what do you need? You need luck. And what do I mean by luck? As Seneca famously said, luck is what happens when preparation meets opportunity. In such a scenario, where the stock market will not give you time to prepare, knowledge, patience, and discipline are key. You should already know all the high-quality companies from the 500 stocks in the S&P 500, all the companies in the Nasdaq 100, their products, their assets, their liabilities, and a vision about how such an event might affect them. Which companies will prosper in the future? After understanding that, you should have a strategy ready to grab the opportunity, like identifying 50 companies that might prosper after the event, then narrowing down to the top 20, with the most drastic declines and investing your $20,000 equally, distributing $1,000 per company in a phased manner while stocks are going down. This way, with knowledge, patience, and discipline, you might make more money rather than trying to find that one stock at its lowest level that will make your money 100 times. Even after doing all this, you need to hold these stocks if they go further down, and need to be optimistic about the future when everyone else is extremely pessimistic, like the end of humanity is near. Remember, humanity has always found solutions to the problems, no matter how big they are. Efforts will be made to resolve the position from the global community, and everything will be normal. It may take a few years, but you need to be ready to hold with that thought in mind. But let's take a closer look at the nature of the stock market. While it generally trends upward over the long term, it always remains volatile in the short term. This volatility is driven by the ever-changing views of people, sometimes highly optimistic, other times deeply pessimistic. Consider reading The Psychology of Money and The Story of Oil. During times of oil price drops, people often panic, driven by pessimistic views. They fear the worst, believing prices will never recover, leading to a massive sell-off. The same happens with stocks. When pessimism takes hold, investors rush to sell, driving prices down even further. Conversely, when optimism reigns, investors buy in droves, pushing prices up, sometimes to unsustainable levels. For new investors, this emotional rollercoaster of fear and greed can be overwhelming. Imagine a new investor seeing a stock hit a new 52-week high. Greed kicks in, and they think the price will skyrocket, so they buy more. But when that same stock hits a 52-week low, fear sets in and they panic sell, fearing it will drop even further. So, are you ready for such opportunities? Absolutely not. How will you be able to grab them? By starting to invest in individual stocks in the stock market, right when everything is going well, learning the skills to identify opportunities, understanding overvalued and undervalued stocks, grasping what PE really means, recognizing the impact debt can have on a company in times of crisis, and knowing which companies have managed through the worst times. Even if you are happy with your mutual funds or index funds portfolio, you should start investing a small amount directly into stocks. Learn how they behave, what it feels like to own individual stocks, and how opportunities arise in normal times. Then you can compare and make the most out of the days when everyone is fearful. Even if you are already investing or trading directly into the stocks, keep these things in mind and enhance your knowledge and skills. After experiencing a lot of stock market ups and downs in the past 15 years, this is what I understood from Mr. Buffett when I read that quote, and made the most out of the small amount I have. Start now, prepare, and be ready to act when the next crisis hits. I hope you found this video insightful. Be sure to subscribe to my channel for more videos to help you learn and grow. And don't forget to re-watch this video to make sure you fully understand the message. Thank you for watching, and I'll see you in the next video.